Here's a scenario that plays out over and over again. The stock market starts dropping, the news is wall to wall panic, your portfolio's in the red, and every instinct in your body is screaming at you to do something, to sell, to wait it out, to do anything other than keep buying. And that gut reaction, it feels completely rational. But here's the thing, it's almost always the wrong move. In fact, some of the greatest wealth building opportunities in history have happened right in the middle of moments that felt exactly like that. Today, we're going to talk about why the market downturns aren't something to fear if you have a long term horizon, and more importantly, how to actually take advantage of them. Let's start with the big picture, because this is the foundation everything else builds on. The stock market, over long periods of time, goes up. That's not wishful thinking. It's one of the most well documented patterns in the financial history. Since 1950, every single decade has ended with the S&P 500, which tracks the 500 largest companies in America, higher than it started. Every single one. That includes decades that contained crashes, recessions, wars, oil crises, political turmoil, and global pandemics. Through it all, the long term direction has been up. Now, here's why it matters for you. If your time horizon is 10, 20, or 30 years out, meaning you don't need this money next year or even in the next 5 years, then a market downturn isn't a financial emergency. It's a temporary price reduction on assets that historically strongly suggest will be worth more in the future. The problem is that our brains aren't wired to see it that way in the moment. When the market drops 30%, it feels like the world is ending. But zoom out on any historical chart, and those drops look like minor blips on a line that's been climbing for decades. Here's a stat that really drives this home. Since 1950, the average market recovery in the 12 months after a recession ended has been about 15.5%. The market doesn't just come back, it tends to come back fast and strong. And the investors who are sitting on the sidelines in cash when it happens, they miss it entirely. Now let's talk about the real evidence, because history has given us some very clear examples of what happens when you don't panic. Take the 2008 financial crisis, the worst economic crash since the Great Depression. The S&P 500 dropped almost 57% from its peak in October 2007 to its bottom in March 2009. Unemployment doubled. Banks were collapsing. It felt, for a lot of people, like the financial system itself might not survive. And yet, if you had bought into the market at the March 2009 bottom and simply held on, the S&P 500 had fully recovered all of its losses by 2013. And by the time the next decade was done, you'd have multiplied your money several times over. Some individual stocks were on sale at prices that almost looked unbelievable in hindsight. Microsoft dropped from about $37 in 2007 down to under $15 in early 2009. Those shares now trade in the hundreds of dollars, a gain of over 1,700% from those crisis lows. Apple went from over $7 down to under $3. Today, that same share, adjusted for splits, is worth dramatically more. The companies didn't stop being great businesses, they just went on sale. Then there's the COVID crash of 2020. This one was even faster and more dramatic in terms of speed. In just 5 weeks between February and March 2020, the S&P 500 dropped 34%. 5 weeks. It was one of the fastest market drops ever recorded. And yet, by August of that same year, just 5 months later, the market had fully recovered. By December 2020, it was 16% above where it was before the crash even started. And if you were to measure from the very bottom of the crash on March 23, 2020, through the following 4 years, the S&P 500 returned over 150%, about 25% per year. And the investors who panicked, sold at the bottom, and waited for things to calm down didn't just miss the recovery. They locked in their losses and watched from the sidelines as one of the strongest bull markets in history took off without them. The lesson across every single one of these crashes is the same. The market comes back. It always has. And the people who stayed invested, or better yet, kept buying, came out dramatically ahead of the people who didn't. Okay, so let's say you're convinced that buying during a downturn is the right move. But here's the next problem most people run into. You don't know when the bottom is. Nobody does. Not professional fund managers, not financial analysts on TV, not anyone. Trying to perfectly time the lowest point of a crash is what's called market timing. It almost never works, even for the experts. This is where dollar cost averaging comes in, and it's honestly one of the most beginner-friendly strategies in investing. The idea is simple. Instead of trying to pick the perfect amount to dump a lump sum into the market, you invest a fixed amount on a regular schedule, say every week or every month, no matter what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, the same fixed amount buys more shares. Over time, this naturally averages out your cost per share, So you're never accidentally going all in right before a further drop, and you're never sitting on the sidelines waiting for the bottom that might not come when you expect it. During a downturn specifically, dollar cost averaging is incredibly powerful. As prices fall, every regular contribution is buying more shares than it would have at higher prices. You're building your position gradually, taking advantage of lower prices without the pressure of having to call the exact bottom. And when the recovery comes, as history shows it does, you're already fully invested and positioned to benefit. The goal isn't to be a genius, the goal is to be consistent. Now, here's a concept that makes downturns feel completely different when you understand it. Quality companies go on sale during crashes, and the sale has nothing to do with the quality of the business. Think about it this way: when there's a financial panic, investors sell everything: the bad companies, the mediocre companies, and the great companies. Fear doesn't discriminate. A blue chip company with decades of earning growth, a strong balance sheet, and a loyal customer base will see its stock price drop right alongside a struggling company that probably deserved to drop. But here's the thing: the business itself didn't change. The products are still selling. The management is still running things well. The competitive advantages are still there. The only thing that changed is when the market is willing to pay for it today. And today, it's willing to pay a lot less. This is the difference between a stock's price and a company's actual value. In a panic, those two things disconnect dramatically. And for a patient investor with a long time horizon, that disconnect is an opportunity. You're essentially getting a discount on ownership of great businesses. Businesses that, based on history, will continue to grow and create value for decades to come. The key word there is quality. You're not buying anything just because it's cheap. You're specifically looking for strong, established companies whose prices have dropped because the whole market dropped, not because something is fundamentally wrong with the business itself. Let's look at two investors for an example. Both 30 years old, both with the same income, both investing in the same S&P 500 index fund. Investor A keeps investing through everything. When COVID hits in February 2020 and the market starts collapsing, they keep making their regular monthly contributions without skipping a beat. It's nerve-wracking, the news is terrifying, the portfolio is bleeding red, but they don't stop. Investor B panics. They watch the market drop 10, then 20, then 30% in a matter of weeks. And in late March 2020, right around the time the S&P 500 hits its absolute bottom on March 23rd, they stop contributing entirely. They tell themselves to wait until things calm down. They sit in cash through the spring and summer of 2020, telling themselves they'll get back in when there's more certainty. Here's what that pause actually cost them. The S&P 500 bottomed out at around 2,200 on March 23, 2020. By August, just 5 months later, it had fully recovered every single point it lost. By December of that same year, it was 16% above its pre-crash highs. And if you were to measure from the March 23rd low through the next 4 years, the S&P 500 returned over 150%, roughly 25% per year. Now here's the part that really stings. The single best day of the entire recovery was March 24th, 2020, the very next day after the bottom, when the market jumped 9.4% in a single session. One day. Investor B missed it because they were sitting in cash waiting for more certainty. Research consistently shows that about 78% of the market's best interval days happen during bear markets or in the first 2 months of the new bull market. In other words, the days you most want to be invested are the exact days fears tells you to stay out. Every contribution Investor A made during those discounted months, buying shares at prices that will never be that low again, compounded on top of that 150% recovery in everything that followed. Investor B didn't just miss the returns during the crash. They missed buying shares at the lowest prices of the decade, and they missed years of compounding growth on contributions they never made. Over a 30-year investing life, that gap in final wealth doesn't amount to a few $1,000s. It can be hundreds of thousands. Not because Investor B did anything dramatically wrong, but because fear caused them to pause at exactly the worst possible moment. And this is the real cost of sitting out a downturn. It's not just the returns you missed during the crash. It's the decades of compounding growth on the shares you never bought at prices you'll never see again. So let's pull it all together. If you have a long time horizon, if your retirement or your major financial goals are 10, 20, or 30 years away, a market downturn is not an emergency. It is a sale. The historical evidence is overwhelming. The market recovers, quality businesses continue to grow, and the investors who stay the course consistently come out ahead of the ones who don't. You don't have to be fearless. Watching your portfolio drop is generally uncomfortable, and anyone who tells you it isn't is lying. But the move is to feel that discomfort and keep going anyway. Keep your regular contributions going. Take advantage of lower prices through dollar cost averaging. Focus on quality. And trust that the same market that has recovered from every crash in history, the Great Depression, the dot-com bust, 2008, COVID, is not done going up. The best time to invest is consistently over time. The second best time is during a downturn, when everything is on sale. Don't let fear talk you out of one of the best opportunities the market will ever hand you. Drop a comment below. Has there ever been a market drop that made you want to stop investing? I'd love to know how you handle it. And if this video helped, make sure to subscribe. There's a lot more to come. Thanks for tuning in. Same pace next time. Keep compounding.